Good evening, everyone, and welcome to the Power of Passive Investing. I hope everyone is having a great summer. We are having an amazing guest today. His name is Hicham, and I forgot to ask how to pronounce his last name. So, Hicham, please help me how to pronounce your last
Hajhamou.
name.
Hajhamou.
Hajam. Okay, thank you. And I apologize. I didn't want to mispronounce it. Um, Hicham and I met through a real estate mastermind where we got to know each other. And as I learned more and more about him, I realized that he has a extensive background in the financial services industry and kind of unique twist on things. And that's why I invited him today because I wanted everyone to tap into his expertise and his knowledge and learn what's available out there from someone who not only has the expertise but also has been able to apply a lot of the skills that he's going to be talking today to his own personal and professional life. So without further ado, Hicham, welcome. Please take the floor.
Thanks, Alina. I'm happy to be here. And hello, everyone. I'm located in New York. And as Alina said, yeah, my background is in finance. So I traded global macro and fixed income and inflation type of products, currencies and commodities for the last 25 years. And, and started investing in all kinds of various assets over the last few years. And, the goal, like I think many of us, is really to get to that what they call FIRE, which is financial
Independence.
independence and and
Retire
retire
early.
early. So all that goal is to get your time and financial freedom really, and what are the tools that are out there to help you do that, and to be able to do all these things. A lot of the time it starts with really changing the way you think and a little bit of mindset work in the background. I thought I told Alina I was maybe going to share some few things, not many, but let me try to see just that one slide that I think
By all
is.
means, and Hicham, maybe you want to tell our audience a little bit more in terms of where specifically your financial background has been, so people can understand where you're coming from.
Yeah, so my as I said, my background, I worked at both large banks and hedge funds, and always focused on more the global macro and fixed income side of the public markets. And what that means is just like taking looking at the global economy, looking at macro dynamics out there, and try to take advantage of them, and kind of forecasting a little bit, what how are the economies going to change both in the U.S. but abroad, and what does that mean for different asset classes, and taking advantage and in investing in those assets, to generate revenue, and so I've done that for the last 25 years. I've had also a stint in fintech, where we launched a dark pool. It's a basically a trading platform for U.S. Treasuries and inflation. And yeah, in the last few years, I covered, also did a little bit of sales in the same assets. And so that would mean like covering like hedge fund managers and portfolio managers, and discussing ideas and showing them ideas, and then executing some of those ideas in the real world.
Awesome.
Yeah, so as I was saying, like I think it's really just starting to switch a little bit your mindset to get to where you want to really be intentional about what you want to do. And so I'm putting these slides just to kind of put it in perspective, but it's more like going from a fixed mindset to a growth mindset. And so it seems that society just wants you to everybody be in the same herd mentality, and where you go to a good college, you get a good job, you get a good 401k, you get bad debt because you don't want to use debt and except for your primary residence, and then you invest in stocks and bonds in your 401k, pay a lot of taxes, follow the herd, and then retire at 65. Hopefully, you have a little bit of savings, and slowly they're gonna just dwindle as you have no income, no other income coming in. And so, it's really that do first, have, and be versus a growth mindset where it really turns it upside down, where you be, you do, and then you have. And for that, to get to financial freedom, I think it's really like, it's not just about learning when you're in college or in school. It's really, life is a learning. It's an everyday learning. You learn through school, you learn through masterminds, you learn through mentors, you learn through your experiences. Nowadays, you have so much wealth, at your fingertips with the internet and all kinds of even schools with Udemy, or you can find any class for free that you can take. There's so many resources out there. It's a beautiful time to be alive. uh, and then instead of getting a job is great. I mean, I'm not saying like you always just want to be an entrepreneur and be in that situation. You can have a W-2, but even if you have a W-2, that doesn't mean that you can continue to try to expand your horizons by either finding a side hustle or buying a small business on the side, or finding some ways of building recurring revenue. Same thing with 401k. 401ks are great, especially when you can get a match from your company. But at the same time, there's other things out there that we call like self-directed IRAs or 401k solos that kind of help you. In a 401k, you're really limited to what you can invest in. Usually it's like stocks and bonds, like Fidelity. You have a small universe of things that you can invest in. Whereas if you take that 401k and you transform it into a 401k solo or self-directed IRA, you can use that money for anything. You can use that money to invest in, other ventures like, venture capital or private equity or real estate, so that just really expands the universe of investment that you can make. And then we'll talk also about like, tax efficient ways of having it. So instead of having just a 401k, try to use like a Roth 401k where you pay taxes today, where you have a small egg. And then as that egg grows, if you're in a Roth IRA, anything that comes after, you won't pay taxes on it. So it's better to pay taxes today on a small portion. And then as that grows, it comes out tax free for you. And so, always prefer those like, Roth type of IRAs. Same thing, a lot of the people, they, when they invested, they either fully in the stock markets or some bonds and stocks, the 60-40 portfolio. But, just broaden your mind again into, there's so many assets that you can invest in out there. Obviously, as you get into more like private markets versus public markets, it comes with its, risks, and you have to evaluate those risks, and you have to do a lot of more due diligence. But you are able to invest in anything. You can invest in real estate. In real estate, you have a lot of different assets that you can invest in, from self-storage, mobile homes, multifamily, short-term rentals, land deals. There's a lot of things that you can do. And then, instead of following the herd, you, again, just be creative. Always think about, different, what I call the life hacks, and surround yourself by, with people who are in the same mindset, the same growth mindset, because that's how you shrink time, right? Like, and there's a couple of ways to shrink time, right? We're on this planet for a short amount of time overall. And so, the best ways to multiply your time or shrink your time is, to do it through either finding mentors or masterminds or coaches that are going to help you to, grow faster and do things on an accelerated basis. And you learn from them, right? Like, why are you talking to those people because they've done it before you, right? So instead of you going through the motions and making all those mistakes, learn from people who already made those mistakes. So at least hopefully you can jump a couple of steps and avoid some of those mistakes that sometimes are costly because they set you back, right? Like, if you say you want to make an investment and you don't pay attention, you don't do your due diligence, and that operators loses all your money, right? And then now you're back a couple of years, right? That was hard money earned from your W-2 for many years to save it. So, learn from, investors who've done that before, and everybody makes mistakes. I still make mistakes. And so, that's one way to shrink time. The other ways, the other way to shrink time is either to technology or to enhance your processes, right? Like, so, as you start getting into that growth mindset, at some point when you start having those side gigs, maybe, start growing too much. There's too much on your plate. Well, maybe hire a VA in the Philippines to help you, set help you for your day to day and your weekly work that you have to do. Um, and then hopefully when you retire, if you're in that growth mindset, and for the last 20, 30, 40 years, you can start at 20 years old. I started a little too late, but it's never too late. But after all those years, hopefully as you started generating those side cash flows and horizontal income on top of your active and vertical W-2 income, well, hopefully you have generated cash flows, and then your investments start working for you, and you can use them in retirement. And hopefully in retirement you're not in a lower tax bracket, you're still in a high bracket, because you've built all that over the years. And things take time, right? Like, it's, as I say, a lot of people sometimes they start looking at all these things, they're like, oh, I'm quitting my job tomorrow, that's it. Take a breather. Everything is really taking time. There's some advantages in being in a W-2, even like getting lines of credit. You have to prepare to get into that other side of building cash flow and being able to retire early. So, I'll stop there, and if there are some questions around there, and then we can dig into a little more into all these things.
Thank you, Hicham. Yeah, this was a great intro, and I couldn't agree more with you in terms of changing your mindset and thinking differently. And I remember reading the book Mindset by Dr. Dweck and thinking, wow, these are all great concepts, but how can I change overnight? And, you only come to that realization over time that it's taking baby steps. It's not how can I change overnight. It's what can I do today so that I change tomorrow. And it all kind of adds up when you start making small adjustments in your life and start thinking differently. Over time, you realize the compounding effect of it. It pretty much works the same way as on Wall Street. Over time, you get more and more of it, and then you see that multiplier effect, and you see that you have changed. And surrounding yourself with the right people also helps. And you and I both know that, being in a group of other advanced real estate investors who are all pretty much have similar goal of buying properties and building wealth, not just creating passive income, as Ash always says, but building wealth and um, leaving a legacy and really positively impacting the society and the communities around us is one of the main goals and objectives. So I would say for the most part of all the people in our group. So that's really important to have the right folks in your surrounding. And one last note that I'll say, I saw on your slide a bullet about dying with zero. I don't know if I necessarily agree with that author. I read the summary of their book and I understand the concept. Um, Maybe it's a different mentality. I don't know. For me, for someone who is an immigrant, I have a mentality that I want my kids to have a better future than I've had. And maybe that's wrong, but that's how I'm thinking. I know Warren Buffett only gave $1,000 to his son and said, do whatever you want with it. I guess everyone starts differently, but not to say that whatever I'm creating, the legacy and the wealth that I'm building is going to be just by default passed to my kids. No, there are certain criteria that I want them to meet, and I'm trying to make it as strict on them as possible, that I will want them to work towards, not just by handing them over what I've created. So that's how I see building wealth, and that's how I see passing that legacy and having future generations uh, earn earn it to a degree, but also make it on their own and create the paths for themselves based on what they see around them and based on the experiences and the mistakes that their parents and their predecessors have made instead of making their own mistakes.
Yeah, no, I wholeheartedly agree with that. And that's why I put like die with zero optional. And But I think you're right. It is like, for me, same thing. Obviously you want a little bit of legacy, and we fought so hard to, and we're still fighting to get to that, time and financial freedom. I think it's not a bad thing to help your kids also get there, just get there faster than you did. And so, what they say, and we can talk about asset protection because also another, important matters, especially, in 2026. The law is changing from, I think 26 million to about 14 million per couple as a, transfer, where you will be able to transfer wealth to your kids tax free, and anything above that will be taxed. So it's, it's a good problem to have, to be above $14 million. But like, it's not, even if you're not there today, you want to think about it today, because if you're like 30 years old and you have, another 35, 40 years ahead of you before, you start thinking about these things, there's a good chance that your net worth is going to be above that. And so if you can put already some assets away in an efficient, asset protection and estate transmission way. But I was talking to this like estate, lawyer, who helps, families with their legacy and transferring money efficiently to their families and kids and dynasties. And he said, a little bit what you said. It's not about handing it to the kids. It's about also, you know being intentional in educating them. It's being intentional, like as soon as they start getting to, being 16 and 18 and 20, they can start understanding real estate investment. They tend to say that usually 25, 27 years old is a time where, if you had a will, like for example a revocable trust, or some sort of a trust for the family, you start adding them as co-trustees, so they start understanding for themselves what that means, and you start explaining all these things to them, and you start involving them more in the wealth of the family, and how to build it, really. So it's like anything, just you just start early with them, and you just gotta make them, co-pilots as they get older and older. And then, even in your revocable trust, what people say is like, obviously don't hand out the whole amount. you know God forbid you pass when before, when they're young, at 16 or 18, for example. Well, they tend to have like a trustee until they get to a certain age, and then maybe you just start giving a little bit at 25, 30, but really mostly at 35 and 40, the larger amount, so that, they have to work for it first, and then hopefully, when they get a little older, they are, they made some mistakes as well. They're not gonna just waste that money, because as they say, it takes one generation to lose it. So
Yeah, I completely agree. I definitely agree that it takes some while for them to mature. Plus, I think once they pass that 30-year-old threshold, they start realizing that money don't grow on the trees, and it takes hard work to earn them. So I feel like they're mature enough at the time to gradually receive take the wealth over from parents that the parents are passing to them. And so definitely a good topic. And you probably remember that I'm very passionate about the topic of educating kids. I don't remember if I mentioned to that I'm doing the TEDx this year in the fall on empowering parents on how to teach their kids financial literacy from grade school on at home without waiting for the schools, without relying on schools, just doing it at home. And you don't have to have Harvard MBA to do it. You literally don't have to have any degree. You just teach the kids from your own examples. These are the mistakes that I've made, and I don't want you to repeat my mistakes, and just share with them your own experiences. I worked in such and such career all my life, and it's a lot of hard work. And if you want to do something else, by all means. But if you're planning to follow in my footsteps, expect X, Y, and Z. And that's how the kids learn. And by also listening to the parents at the dinner table and seeing what the parents are talking about, what parents are discussing, helps the kids to form their own opinion and to better understand what's out there. That real world is not a textbook, and they do not teach kids in schools, not even in high schools right now, how to approach the real world. And I think they should.
Yeah, no, absolutely. And I'm all for, teaching kids, and also, like, you only learn by doing as well, right? Like, so at some point you just same thing, need to jump. And nowadays, as I say, we're lucky to live in a society where you can already start doing a lot of things. I have a green light card for my kids. They can start putting, even if it's just like a few dollars here and there on different stocks, they can do that. You teach them about, like, they can start a website where they can, sell some stuff. My younger one had a slime business online, and all kinds of things. So there's a lot of, ways to start doing at an early age nowadays.
For sure, for sure. I like the concept that you called compressing time by leveraging, again, the expertise of others, surrounding yourself with the right people, and then leveraging not only the virtual assistants. Nowadays, you can leverage AI to help you with certain things and automate things. For example, even with Zoom, Zoom had installed this new feature where you don't need third-party provider to create notes. I can literally just click a button now in Zoom that will create the notes based on any meeting I'm having. And granted, it's not going to be 100% accurate, but it will be about 90% accurate, which is good enough, which entails that you and I don't have to take notes, and we can just use the notes that Zoom creates for us, and that will be good enough for us to remember what was discussed in the meeting, and then we can use it to do further follow-ups afterwards. So I think it's really amazing what AI has been providing us with, and I'm sure we'll see a lot more capability down the road. And I see a lot of people creating applications using the AI, which keep amazing me every day, because I see new applications on a regular basis. With that,
Definitely going to help with productivity for sure.
yeah, yeah. Well, hopefully for some of our W-2 folks, I'm sure they wish there would be applications that would help them do the performance reviews in Life 360. I know many people
Yeah.
doing those. But anyway, Hicham, you mentioned in your notes that you would be talking about building horizontal cash flow. Do you want to touch upon that as well?
Yeah, absolutely. But, I think first thing first is more like just, start looking at, your kind of legal and tax structure, right? Because, it's a little bit the, cash flow quadrants uh, from
Robert
Rich
Kiyosaki.
Dad Poor Dad, right? Robert Kiyosaki. Yeah. I had another slide. I'm happy to share it, but,
Please
you know,
go
it,
ahead.
it's okay. Sure. One second. Let's see. But yeah, so it's, because as an employee, at the end of the day, you're basically gonna pay the most taxes, right? You're gonna be so the middle ground is, and W-2 employee is the one who's like contributing the most taxes overall to everything. And then you pass to these, self-employed, to business owner, to investors. But, like, as a business owner, there's a lot of things that you can deduct from your businesses, right? Like, you can have your home office, and deduct that from it. You can hire your kids into your small business. And it doesn't have to be a business, like a huge business. It can just be a consulting business. It can be, a small side hustles that, you and your wife are passionate about magic and you have magic classes online, or, some side gig, but at least you have a legal structure where you can, from there, you can start maybe same thing, a 401k solo out of that. You can have a lot of deductions, and those are going to be much more tax efficient than that. Also, if you're a W-2 person and you're trying to reduce your tax base, the best and easiest way to do that is to have your spouse, if she's not working, or he is not working, to become like a real estate rep. And why is that? Because then, let's say you're going to make passive investments that are going to generate depreciation, and we can talk about that in a minute. If I invest in a mobile home park, for example, that Alina has found, and she's going to manage, and I'm just going to be a limited partner. I'm just going to give her money. I'm going to be passive, and every year she's going to give me coupons and this and that. But the first year, hopefully she's going to give me, after doing a cost segregation, some tax depreciation. And if my wife, for example, is a real estate professional, then I can use that depreciation, because it's coming from real estate, against my W-2. So let's say my salary was $250,000 and I invested $50,000 with Alina, and she managed to get me 100% depreciation the first year. So $50,000, I can take that $50,000 and hit it against my income. So if I make $250,000, I invested $50,000 that are gonna grow and give me cash flow on top of it. But on top of it, they give me a tax advantage. So I'm saving 50 grand, because now my tax base goes from $250,000 to $200,000. And so I just saved, 40% on $50,000, right? So $20,000, instead of giving it to the government, I put it in Alina's deal, and I reduced my tax base. So that's a great advantage if you can do that, or if your spouse can become a real estate professional. And that doesn't mean that she automatically has to be a real estate person who sells houses in your neighborhood. There are ways you can get that status as well, by having short-term rentals and managing them yourselves. There's different ways to get that. If you can't have that, the second best way is to invest in oil and gas. It's a little more risky, and it's harder to find good, solid, robust, not too risky investments in oil and gas, but those are also can come as a deduction to against your W-2 income. And that's because in oil and gas, the first year you are not an LP, a limited partner, but you go into a syndication as a general partner for the first year, and then they transform you into an LP the year two. But by being a GP the first year, you are able to claim that as an active income in a way. And because they get also a lot of depreciation, you can get that against your active income and your W-2. So first, think about your legal and tax structure. And then when you're comfortable about, that setup, then yes, how do we build passive income? As I said, there's a lot of different, investments that you can make. I think I have a slide on that too, so might as well just share it. But yeah, here we go. Obviously stocks and bonds that everybody knows about, but there's venture capital and private placement. That would mean investing in a startup or a company that your friend is running, or that you have an interest in. Private equity, private debt, life insurance, crypto. Small businesses are a little more active, and we can talk about that a little later, because that's more like on the active side, but that's probably a way of generating a lot more cash flow and return on your investments. But obviously it comes with a little more activity, and then Uh, the way I like to diversify my investments, and I diversify my investments, I look at, on a risk adjusted basis. And on a risk adjusted basis means what? Means every investment has some sort of returns, right? Like stocks over the long run have about 9% returns. Private equity has about 15% returns, but they all have different volatility, right? Like, so stocks have high volatility. They have, close to 15, 16, 17% volatility. So on a risk adjusted, if I take that return and then divide it by the volatility, I get what they call the Sharpe ratio. Well, so if stocks are 9% and a 15% volatility, obviously the Sharpe ratio is lower than 1, whereas private equity is a 15% return and uh, you know, about 14% like volatility. So it's a Sharpe that is above 1. So already private equity over the long run tends to be a better risk reward than pure public stocks. But it comes with other prices, and that's where you have to correct as well for other things like liquidity, right? Like, so if I own a portfolio of stocks, I want to sell them tomorrow, I can press a button, sell everything, and I have cash. If you put your money in private equity, you're probably not going to see it for the next 7 to 10 years. And so that liquidity has a price as well. And so you have to compare all these factors. And then when you invest in real estate, you get other advantages, as I mentioned before, like depreciation is a big one, right? Because we love depreciation because we can deduct it from our either active or passive incomes that we get. Real estate has both cash flow. They pay me on a yearly basis some cash flow from the operations of the real estate. Maybe it's your rental income, or and then also there's appreciation, right? There's always not enough housing. We hear that every day in the papers. There's never enough housing for the growth of the population, and therefore real estate keep appreciating. Real estate is also a great hedge against inflation, right? Because real assets, they tend to stay up with inflation. So whereas if you have your money in the bank and inflation is 5%, and the bank is paying you 1, where you really losing 4% a year. Whereas in real estate, if inflation is at 5%, you tend to have appreciation on a yearly basis, at least equal to inflation. And so that's always a good appreciation. And then, as I said, there's also what your counterparty risk and the risk that you're taking, by being in very institutional platforms that have, billions underneath. They have a lot of compliance going to it. So they're going to tend to be safer compared to, like, if I go to a small real estate syndication with a new operator that's been only in real estate for 3 years and started doing his own deals because he's been doing great, and now he wants to grow and he needs leverage, and he has his friends and family money, and then maybe some outside investors, friends of friends. And so here, obviously, you're going to be on a different scale in terms of risk. And so, maybe you're going to have better returns from him because obviously he doesn't have all the, extra uh, payments that, a big institutional platform has to have in terms of lawyers and compliance and all these things, offices that they have to pay for. So hopefully you get a higher return on one side, but it comes with more risk. So again, adjust for that, counterparty risk. And so, I like to have really a diversification in terms of public markets versus private markets, as well as, institutional versus non-institutional plays that I do, that I invest in. And then hopefully that diversification, gives you enough, appreciation and cash flow. And then that's the other way to look at that is, is it an appreciation play? Meaning, let's say invest in a, startup VC. I'm probably not going to see cash flow because every cash flow is reinvested in that business on a yearly basis until they go IPO on the NASDAQ. And then, if that happens, then I'll be a rich man. So that's more like an appreciation play versus a cash flow play where, I'm going to I really want to have coupons coming out every year from this. Either a bond can do that for you or a real estate syndication. And, especially if you're in that mode and mindset of like, at some point I want to quit my W-2 and that's why I'm doing this, you want to have cash flow, right? Because you want to live off those cash flow as you start your early retirement play. And so, the third and last thing is really about like, what money am I going to use for what investment? And so I think that's important. And sometimes people make a couple of mistakes, and we're going to talk about due diligence in a minute. But one is they invest the same amount of money in anything they do. It's always $50,000. It's this small real estate syndication or this equity play that I'm doing with an institutional platform. 50 grand here, 50 grand here. Well, no, as I said, there's different risk rewards. So when you adjust for the risk that you're taking, size your trades differently, right? If I'm doing a VC play, a startup, I'm not going to put the same amount as I'm putting in a multifamily deal that's supposed to have very stable cash flow and low volatility, right? Because it's a much riskier. But at the same time, the VC play, I'm probably going to I could multiply my money by 10 or 20. So even if I put $10,000 and multiply it by 10, then I'll get 100 grand at the end. It's probably the same as if I put 50 grand in a syndication that is hopefully in 5 years going to multiply by 2 and give me 2 times my money, where I'll have 100 grand. In both cases, I'll have 100 grand, but I started with 10 grand on one and 50 grand on the other one. So think about sizing. And then, as I was saying, think about the money that you're going to use, right? So if I have a 401k or a retirement account that is growing tax free, well, then I'm gonna tend not to use that money for a real estate syndication unless it's like a land deal that is more like just an appreciation play. But if it's a deal where I'm gonna get a lot of depreciation, I want to use that depreciation against my active income in a non-IRA money, right? In the IRA, that's where I'm gonna put like, maybe private equity, VC type of play, land deals, things that are not going to give me cash flow, but are supposed to give me a lot of equity multiples. Uh, if you're going to use your own money and savings, then yes, put it in real estate where potentially you can get depreciation that you can get against your active income. And then, manage also your cash management, right? Like you have to keep some money for rainy days. And so nowadays, the good news is that you're getting paid for it, right? Like rates are at 5%. So you can get a money market fund that gives you 5%. You can also get some debt funds that are not too risky that can pay you all the way up to like 8 to 13%. So if you average these two things, I call that bucket my money market bucket and money management, like 0 month to 18 months. So it's money that I need between 0 and 18 months. And then I'll have a little bit in money market that I can sell tomorrow. Some in, either hard money lending or debt funds that are going to pay me higher percentages, but I'm probably going to have to keep it for at least, a year to 18 months with those operators. And so, manage also your cash management, because nowadays, instead of staying at the bank and earning zero, you might as well just, get something, especially with the inflation that we're having. So I'll stop there, and maybe there's some question that came up from this discussion.
Sure. Thank you, Hicham. This was certainly a lot to digest, and a lot of great content and good breakdown in terms of alternative assets. And I noticed that you list some of the alternatives that are available on stock market, but also some that are available outside of the stock market. And you mentioned institutional funds. So institutional funds have typically been perceived by like regular accredited investors as something that's hardly achievable and usually something that not readily available to the everyday investor, either because of the minimums or just because they don't really advertise much. It's usually for ultra wealthy individuals or just through private clubs and stuff. Do you have any suggestions for someone who wants to learn more about institutional funds and just better understand when they're eligible and how to invest in them, what would you suggest as a resource guide to read about this and to understand it better?
Sure. Yeah, no, and I think nowadays, the financial engineering that we have out there allow people to come in at lower minimums. I mean, sometimes they still need to be at least an accredited investor. Um, and then, I'm happy to talk about what that means. But overall, like for example, I have a fund where, my group of investors, we, tend to find some deals for them that are, kind of institutional, but because they have high minimums, let's say it's $1 million or $5 million minimum to come in. Obviously, as an individual, we're not going to be able to do that for a single investment.
Oh, it's not
But
obvious. I mean, we don't know what your net worth is, so don't say it's obvious.
yeah, fair enough. But what we do in our fund of fund, like we find those institutional play which look interesting to us. We obviously do a lot of due diligence before we bring anything to invest in to those our investors. But then our investors, because we're a fund of fund, we can decide. So as a whole, as a group, we are going to be above that $1 million to $5 million threshold that they require. But at the same time, we'll be able to have lower minimums. So, as low as, whatever, 10 grand, 25 grand, 50 grand, depending on the opportunity investment that we have. And so that allows people to come in at lower minimums. And also because we tend to go, together with larger check amounts, we sometimes have more power, not so much for the real institutional plays, which we know is going to be, they're not going to give us special terms, but for other smaller investments where we are a bigger piece of the investment group, then we have more power to negotiate better terms for us, right? So sometimes in syndication, let's say, the traditional investment you're going to see out there sometimes, or you'll get a 7% coupon and a 70-30 split. What that means is that 70% of the income and appreciation is going to come to you, and then 30% is going to go to the person who's managing the real estate deal or whatever deal. But sometimes instead of getting 7% and 70-30, because we go in as a bigger group, we ask for better terms. And so we are able to get you maybe an 8, maybe a 9% pref instead of a 7, and maybe a 75 or 80%, 80-20 split versus a 70-30. So, there are ways to access these things through fund of funds like ours. And sometimes in the stock market, you'll find kind of the equivalent, in a REIT. It's not the same thing. It's not exactly the same thing, but you'll get somewhere there. But at least you'll have a daily or quarterly liquidity, much better liquidity, and still being able to have some exposure to the asset class that you're looking and interested in.
Awesome. Sounds good. Thank you for sharing. By the way, we always ask our presenters to share their contact information. So if you want to post it in the chat, or if you want to just spell it out for the people that are listening, feel free to share your contact information. So if our folks want to reach out to you, they have a way to find you as well.
Yeah, absolutely. So I'll put it in there. It's HHH 3 times at Wealth Flow Partners. So Wealth Flow Partners with an S at the end. So Triple H at wealthflowpartners.com.
Okay, you did that too. Okay, perfect. So they have it twice. Awesome. Thank you. Hicham, we also, as we nearing the end of our wealth hour, we always ask our presenters, how do you like to give back?
Great question. So two ways. It's always, it's time and money, right? And I think I like to do both because, as I said at the beginning, it's always by doing. And, we're human beings at the end of the day. we like to be in communities. We like to, we appreciate the others. And so, I tend to be, I give a lot to, kids type of charities. A couple that I'm sensitive to. I grew up in Morocco, and I give to a charity that empowers young girls in Morocco in the Atlas Mountains. They help them with their schooling and get them to grow as little entrepreneurs, and so that's really dear to my heart. I give to autism as well, and there's a great charity where I'm at in Westchester, New York. I think it's on your side of the pond, just across the bridge, that organizes summer camps for sadly kids with cancer. And every year they have a couple of events in person as well, where you can go and help get the camp prepped and interact with some of the kids that are already there. It's a wonderful, wonderful day, and obviously they have other ways to give through their charities and concert that they organize for them.
Wow, that sounds amazing. What's that last charity called?
Oh gosh, now you're putting me on the spot.
It's okay. You can
Uh, I
drop.
will find it. I will send it to you. It's literally really close to you, across the bridge.
Got it. Okay, yeah, send it to me, because I am also very passionate about children charities, and some of them are similar to yours. So I was just wondering what this one is. But anyway, yeah, you can find it later. Hicham, any parting words for our audience? Anything else you would want to wrap this up with?
No, I mean, just, again, try to change your mindset, connect with people, network, ask questions, send me emails. I'm happy to help as well, in any way I can. And read. There's so much out there. And start anywhere you are. You're always at the place you need to be. And it's, as you said, it just takes a first step, a small step, the smallest step possible. At least you're moving forward, and then other things start coming up, and the universe start responding to your inquiries. So
Absolutely. Yeah, absolutely. I definitely agree with you. It's a matter of how you perceive the world, and the world will respond in a similar manner back to you, to your perception. So yeah, I couldn't agree more with that. Well, I know we have a lot in common, but I'm finding out that we have a lot more in common than I thought. So that's again, Hicham, thank you so much. This has been an amazing interview, and you've provided a ton of value for audience folks. If you're looking to learn more about what Hicham does, or if you want to learn more about his fund of funds that invests purely in institutional type investments with a much lower minimum thresholds, as you heard, feel free to reach out to him. The email is in the chat. I believe, Hicham, you're also on LinkedIn, right? If someone wants to reach out on LinkedIn, they can find
yeah,
you there.
absolutely. Yeah.
Yeah, so but don't hesitate to reach out. Hicham is a very giving person and has a ton of knowledge. He's definitely has a lot of street smarts, and educational is a lot of smarts as well. So thank you very much again, Hicham. Great to have
Yeah,
you.
my pleasure. Thank you for having me.
Absolutely. Have a good evening, everyone. Bye.
Get back.